everyone. My name is Caroline Mora. I will discuss the China market outlook in 2025 today. In 2025, we think domestic demand stimulus will likely be a key theme for China. As you can see from the left table on this slide, the stimulus package since late September shows that the central government is increasingly concerned about weakness in the economy and the markets. The style of communication is firm, direct, and even with forward guidance, suggesting a high level of consensus and authority. Especially the 10 trillion RMB local government debt resolution plan announced after the MPC Standing Committee meetings suggests that policymakers now emphasize both risk prevention and the promotion of economic growth. We saw a better retail sales growth with a sharp increase in sales growth of autos and home appliances in response to the boost from the trade-in program for consumer goods. Both manufacturing and service PMI re-entered the expansionary territories in October, supported by the growth stimulus measures. However, we believe the policymaker will still need to take up additional measures, especially on the fiscal easing, to boost consumption and help the economy exit deflation, especially against a backdrop where loan demand is weak and real interest rates have been restrictive, given the persistent deflationary pressures to sustainably turn around investor confidence. Besides, it is market consensus that property sector is the most important area to work on to revive Chinese economy. After the latest round of stimulus policy announcement in late September, property sales turned positive year-on-year growth in October, first time in 17 months, while secondary sales also rebounded to 20-month high. However, with a 2.36 billion square meter of GFA sold under construction and unsold inventory of 3.27 billion square meter, we estimate that around over RMB 3 trillion is required for the housing market to return to a healthy property inventory level by mid-2025. With recent strong export data, further domestic demand stimulus and fiscal easing spending may only happen after the new tariff policy under the second Trump administration becomes clearer in 2025. Next, I will pass on to my colleague Jennifer to cover the frontier markets. Thank you.
Thank you, Caroline. My name is Jennifer Passmore, and I'm going to be talking to you about frontier markets today. In our view, frontier markets bring diversification benefits and return enhancement. Over the long term, frontier markets show lower correlation to developed markets than emerging markets, and low correlation within frontier markets. Many of these economies are more domestically driven and not as influenced by global market drivers. With respect to return enhancement, you'll see in the chart shown that the volatility of the frontier strategy on the left offers a lower level of long-term volatility versus emerging markets, and on the right, a higher level of 10-year annualized return. So what about the outlook? Looking forward, several frontier markets have significant room to cut rates ahead of the US as they hiked rates earlier. As inflation has already normalized, there should be a tailwind for valuation levels. As the globe has shifted to a more multipolar world, frontier markets have tended to pursue neutrality to navigate regional and international conflict through mediation from the sidelines. Similarly, with trade wars in the past between China and the US, Vietnam, for example, managed to benefit from its proximity to China and still maintain a positive trade relationship with both China and the US. For 2025, tariffs may impact, but a China Plus One strategy may still present a continuation of this opportunity. We expect the characteristics that frontier markets have shown will be key to navigating this new reality in the post-US election world. Thank you for joining us today. We look forward to future interactions with all of you.